What's up, everybody? Joe Brown here. This is the Heresy Financial Show. Right now, we are seeing the Federal Reserve force the entire U.S. economy into a downhill spiral. Dollars are getting more expensive globally. We are seeing interest rates go up, which means borrowing costs for both the consumer, the corporation, and the government are skyrocketing. We are also seeing this put negative pressure on both consumer spending and on equities, on asset prices. And as the majority of the United States economy is driven by U.S. consumption, not exactly the type of thing you want to see if you are responsible for causing growth in an economy. And the worst part is not what catastrophic thing will break as a result of current monetary policy, but the reversal, what the Federal Reserve will choose to do after something breaks. Ready? Let's dive in. All right, today we are going to look at some charts and some data points that show that what the Federal Reserve is currently doing is causing a downward spiral, a positive feedback loop that is forcing the economy to a point where something will break and then they're going to have to reverse course. So we're going to look at a number of things. And if you are on Twitter, I highly recommend giving Lynn Alden a follow there. She is at Lynn Alden Contact on Twitter. She this morning did this thread on a couple of these points here and thought it was good enough to go into in detail, make a video about. So the first thing that we're going to look at here is the money supply. Now we have two lines here on this chart. We have M2 and TMS. TMS is the total money supply, the Rothbard-Salerno money supply measure. And we can see here that it is the year-over-year change. So this is not the absolute level, this is the change level. So they're relatively the same other than some of the peaks and valleys here. And one thing you'll notice that at the onset of the government dealing with COVID in 2020, there was a big expansion of the money supply, a lot of money printing. You can see here the total money supply showed more accurately the extent at which the money supply grew. And you are also seeing now more of a severe collapse in the growth of the money supply. Now, one way that we can look at this is by just looking at M2, and we can see as we zoom in here that there was a big spike in the money supply here, and then it grew relatively at a stable pace during this time. And really for the last couple of months, since December of last year, the total money supply has moved sideways. This is due to a number of factors. Number one, it's due to the Federal Reserve monetizing a lot less debt. They are not purchasing as much in mortgage-backed securities or in government debt as they were. And now on a net basis, they are actually purchasing zero. They're planning on trying to sell at some point soon as well. And so when the Federal Reserve prints money, if they just ship it off to, let's say, Mars, that doesn't expand the money supply. So you have to quantify, okay, how much of the money that's being created is actually going into circulation, because that matters. Like Japan, if you print a bunch of money, give it to everybody, they pay off debt and save it and they never spend it. That's very similar to taking that newly printed money and shipping it off to Mars. If it never enters circulation, that's kind of like the money supply never expanded. So when the Federal Reserve prints money and they use that to buy an asset like the United States Treasury or a mortgage-backed security, they're buying that asset from somebody who has that. That means they're replacing on that person's balance sheet, they're replacing an asset with cash. Then that entity can go around and do whatever they want now with that new cash, most of the time buy another mortgage-backed security or buy more U.S. government debt. As this money then works its way throughout the economy, it makes its way into the economy through government spending, and it makes its way into the economy through lenders being able to lend more for purchasing of houses and things like that. You end up seeing an expansion of the money supply, and that bids up prices along the way. Now, when we are looking at this chart here and seeing that the money supply has really moved sideways for almost 4 months now, one of the reasons for that is because they are monetizing less debt. On their balance sheet, we can see their balance sheet has stabilized, has not been moving up as rapidly as it was before. And so they are not creating as much new money as they were before, injecting it into the economy. So that is one reason why the money supply has stopped growing as quickly and really stopped growing at all. It's been moving sideways for 4 months. The other reason is because of interest rates. We're seeing interest rates skyrocket here, which means that lenders are not as easily able to find borrowers. Borrowers don't want to borrow as the cost of borrowing increases. increases. And so it is getting harder and harder to borrow, and borrowing debt expands the money supply. When you go swipe your credit card at the store, that's not money being transferred from Aunt Sally's bank account into your card that then goes into the bank account of the store. That money is loaned into existence. It did not exist before. It does now. It did not exist before you swiped it. Now it exists in the bank account of the grocery store. As soon as that debt is paid off, now that's money that was in circulation before that you got from maybe working. It was in the bank account of the company that you worked for. You get that into your bank account, and instead of putting it back into circulation by spending it on something else, you pay off your credit card balance. That decreases the credit card balance. That money ceases to be in existence at that point. And so the creation and the destruction of debt is actually the creation and destruction of the money supply. When you buy something with debt, that expands the money supply. When you pay off that debt, it shrinks the money supply back to where it was before. So as interest rates go up and borrowing becomes harder, that means the money supply grows slower, and as debt starts to get paid off, that means the money supply is shrinking as a result of that. So as we see interest rates go up and as we see the Federal Reserve's balance sheet move sideways, these are forces that stop the money supply from growing as quickly as it was before. And we can see, as measured by this true money supply, year-over-year change graph, we can see the money supply growth has been cratering recently. Next, if we take a look at the DXY, we can see that the dollar index since June of last year has just been skyrocketing. The DXY is the dollar as compared to a basket of other currencies. So this means relative to other currencies, the dollar is getting more expensive. The DXY is not directly related to things like inflation, how strong the dollar is versus housing or energy or food. The DXY is measuring the dollar versus other currencies. So why does this matter? Well, number one, it's going up because the money supply growth is less for the dollar than it is for other currencies. It's all about supply and demand. If the dollar quantity was to decrease by half overnight, that would mean that dollars become much more scarce. It is much harder to get your hands on dollars compared to everything else, especially other currencies. That would force the DXY index to explode higher. It is harder to get your hand on dollars. Now, we don't need money supply to evaporate overnight to see the DXY go up, as we can clearly tell. So if the DXY is going up, what are the implications of that? Well, that also puts upward pressure on interest rates. Why is that? Because if it is harder to get your hands on dollars from another currency, what you're really saying is it takes more of your own currency to get your hands on dollars. That means things that are priced in dollars get more expensive. Things like U.S. government debt. That means foreigners, people holding foreign currencies, institutions and governments that want to lend money to the U.S. government, that want to buy treasuries. It is more expensive for them now. It takes more of their own savings in order to invest in U.S. treasuries, to lend money to the U.S. government, to buy those treasuries. It is harder to do so. And so that means there is less buying pressure. We know that bonds, the price of bonds and the interest rate on bonds are inversely correlated. If the bond price moves up, that means the interest rate is moving down, and vice versa. With less buyers from the international market, the foreign currency markets, because it's more expensive, that is less buying pressure. That means sellers have a little bit more sway over the bond prices, pushing bond prices down, interest rates higher. So that is why we are seeing, in part, interest rates move higher, especially on things like the United States 10-year. Now, as interest rates move higher, we are seeing that start to influence something we've already talked about, which means it's harder to borrow, which means that is a negative pressure on the money supply. So that's positive feedback loop number one that we see going on here. The second thing is that borrowing costs get more expensive for the U.S. government. But the thing about the U.S. government is that it really just doesn't care about that. It just keeps on spending no matter what. The only hindrance to the United States government spending is political will. And so they keep on spending, which means they're going to keep on borrowing, even though that borrowing is becoming more expensive. So if we take a look here at the United States federal surplus or deficit, this black line that goes through the middle, that is a neutral budget for the government. So that is, let's say they pull in $100 million and they spend $100 million. That means their surplus or deficit was at zero. You can see here for decades, really didn't fluctuate that much. And then it started getting more and more extreme, and we started having deficits pretty much all the time, regularly, And now to even have a little bit of a glimpse above that black line is pretty rare. And obviously, during the last couple of years, we've seen the deficits absolutely explode. And here we are now. One thing to notice, though, about this is that deficits and surpluses are basically the difference between what you make in income and what you spend. And that's the same for you and I. If you and I spend more than we make, we have to borrow to make up the difference. So same with the government. If the government brings in $100 million and they spend $200 million, they have to borrow the difference, the $100 million, to make up that difference. Now, what's one thing about debt that is true? One thing about debt is that it has to be repaid. It's not perpetual. It doesn't go into an endless, infinite time in the future of just paying interest on it, unless it's a perpetual bond, which those don't really exist today. Today, we have maturity on our debt, which means that at some point, the federal government has to pay off that $100 million that it borrowed, which was the difference between its income and its expenses. Now, if you or I are running up a credit card bill each month, and every single month we have to make our minimum payment and we have to pay our bills, and that interest is making that minimum payment get higher and higher because we also keep spending more and more money on that credit card, eventually we get to a point where we have to claim bankruptcy, where the credit card company will stop giving us, letting us borrow more money from them because there's a higher and higher chance that we won't be able to pay it back. Not so with the U.S. government. The U.S. government just keeps on borrowing and borrowing and borrowing, regardless of those interest costs moving higher. What that does to this deficit, it means that more and more of a deficit is necessary just to pay off the debt that they borrowed last time. And as interest rates move higher, more and more of that debt, that new debt that's being borrowed, goes to just paying the interest rate on the new debt. Lynn Alden clarified here that the cost of capital for the United States government, if it reaches a weighted average of 3%, that means all of their debt averaged together, 3%, then the federal interest expense alone would be $900 billion. When you add in the current deficit, you get to well over $1 trillion every single year that they have to borrow just to keep going. And what do we know about supply and demand? It moves prices. And so as the government has to borrow more and more and more just to repay what they borrowed last time, that's more and more pressure on interest rates moving up because you're borrowing more and more. You're putting out more supply. That's going to push the price down because, all else being equal, the buyers can't soak up all of that borrowing pressure from the United States government, pushes interest rates higher. This is another positive feedback loop here, where as the government has to borrow more money just to pay off its old expenses, it drives interest rates higher, which means it drives its expenses higher, and around it goes. It's another positive feedback loop we're seeing here. Now, your classic MMTer would look at this and say, hey, none of this in theory by itself is a problem, because as the United States government spends more money into the economy, that drives up prices. They can direct their spending where it's most appropriate to spur on economic growth, and there will be a much more healthy and much more robust economy, because anything that the government spends, a negative for the government, is a positive for the private sector. That's more money to spread around, that's more money to be reinvested, and ultimately that results in growth, driving prices of everything higher, which will then come back around in the form of taxes to the United States government in order to pay off that debt. Now, in theory, that sounds great, but as Yogi Berra says, in theory, there's no difference between theory and practice, but in practice, there is. And what we notice when we look at the data of what actually happens is quite the opposite. Number one, we are seeing asset prices extremely volatile and falling apart. The S&P 500 is down from its highs. So is the NASDAQ, so is the Dow, so is the Russell 2000. We are seeing equity markets, asset prices get rattled. We are seeing the debt markets get rattled as well. And so the markets are not holding up to this. In addition to that, we are seeing sentiment at rock bottoms. We are seeing people not be able to afford basic living expenses as inflation is getting carried away and pricing people out of being able to afford their everyday items that they need. Not only that, but now we're also experiencing major shortages again around the world, especially in things like soybean oil, canola oil, vegetable oils all around the world, things like wheat. And as inflation goes up, if incomes are not keeping up, people can't keep up with those expenses and have to spend less. Now, we are seeing inflation cause wages to go up, but we have not yet seen wages go up at the same pace as the official inflation rate, and it's probably nowhere near the real inflation rate. What this is doing is putting downward pressure on the American consumer. Take a look at this chart. This is the share of GDP that personal consumption makes up. Now, it used to be a lot less. That's a lot healthier when consumption doesn't make up a large part of an economy. But recently, over the last couple of decades, it is well over 2/3 of our economy. Again, that means that our economy is driven, more than 2/3 of our economy is made up by personal consumption, just spending money. Right now, 68%. And as the money dries up, and as borrowing costs continue to increase, and as people don't have the money to maintain their basic necessities, personal consumption starts to drop. This is not a good sign for GDP. This means GDP will take a hit. Not only that, but US consumption is primarily driven by the top 10% in terms of wealth, which means that housing prices, stock prices, and other asset prices going down will impact those 10% because those top 10% by and large are the ones who own most of the assets. So if the asset prices start to go down, which they are, and then personal consumption dries up as a result, GDP takes a huge hit. Well, what does that matter? Why do we care if GDP takes a hit? Let's look back at the federal surplus or deficit. What is this number derived from? It is the difference between the federal government's income and expenses. We already know that the federal government's expenses are exploding just because of this. Their borrowing costs are going up. But now we're seeing forces that are pushing the federal government's income down because it's derived as a source of taxes, which is a percentage of a price of asset sales from capital gains taxes, prices of incomes, prices of spending. So all these things, GDP getting pushed down, especially because of personal consumption going down because people can't afford to continue buying at the current pace, means that the federal government's income is getting smaller as well. If the income gets smaller, they have to borrow more. If they have to borrow more, that drives up interest rates even higher, which all contributes to this massive reinforcing cycle, positive feedback loop that is putting the entire US economy into this downhill spiral that will result at some point in something breaking. It can't continue forever. Something will have to break. Now, I don't know if it will be a big bank saying, hey, we're bankrupt. I don't know if it will be a large corporation that says, hey, we can't pay our employees. Something is desperately wrong here. I don't know if it will result in all-out World War III. Whatever happens, something is going to cause the Federal Reserve to reverse course because interest rates will just get to the point where either a large corporation that's too big to fail, a large financial institution, or the US government says, hey, we need more money printing. And that's what it's going to come down to. And that's the worst part about this whole thing. If we just got the deflationary spiral here, that is the cure for the malinvestment. All the over-leveraged players getting wiped out. All of the real assets, the ownership of those assets getting transferred to the more conservative players. Getting the clean slate where all of the responsible economic actors acquire the resources that were wasted and that were not handled responsibly by the unresponsible players in the economy. That would set the stage for much more robust growth going forward. It would set precedents for saving, not recklessly spending, and not recklessly going into debt. These would plant the seeds for future growth that would be much stronger than anything we've seen in a very long time. But that's not what's going to happen. We know, based on precedents, based on looking at decades of policymakers' decisions, what they're most afraid of and what they are most likely to err on the side of, i.e. inflation. We know they are going to choose to reverse course with quantitative easing. And we take a look at their balance sheet over the last couple of decades. We can see every single time something major has blown up, they've decided to absorb it on their balance sheet. They did it in 2008. They did it in 2012-13. They did it in 2020. And they will do it again probably over the course of the end of this year. They will probably do it again in 2022. It's a matter of when, not a matter of if. And after that, right now we have to worry about volatility, maybe some deflation. After that time, what we really have to worry about is the onset of hyperinflation. Not yet, but once the policymakers reverse course, once the Fed starts to add to their balance sheet again, blow up their balance sheet, increase QE, print money, monetize the debt. That is the point at which we have to really start to have a conversation worrying about the death of the dollar. And finally, if you've stuck with me through that whole video, I will be in Dallas May 6th through 8th, speaking at the Market Disruptors Live Conference. If you're not already signed up, we've got just a couple of days left. Go ahead and sign up with the link in the description below. I would love to see you there. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.